Okay, so you finally did it. You opened up an investment account, you've got a little bit of money ready to go, and you're feeling that crazy mix of excitement and, let's be honest, pure terror. The possibilities seem endless, but there's one question that's just screaming in the back of your head.
And there it is. It's the big one, right? It's the number one fear every single new investor has, and you know what? It's a totally valid fear. What if I pick the wrong thing? What if I completely mess this up? Well, I'm about to show you a number that might just blow your mind.
Yeah, 90%. Just let that sink in for a second. That is a massive, costly number, and it represents a very, very common reality for people who are just getting their feet wet.
That's right. 9 out of every 10 beginners make the exact same handful of mistakes. But here's the good news, the really good news. Every single one of these mistakes is 100% avoidable. You do not have to be part of that statistic.
So, here's our game plan. We're going to walk through the 5 biggest mistakes, then we'll uncover 3 hidden portfolio killers. After that, we'll reveal your secret weapon, and finally, we'll wrap it all up with your investing action plan. Sound good? Let's dive in. All right, first up, the 5 big mistakes. Seriously, think of this as your field guide for how not to blow up your account in your first year.
Oh, you know this one. We've all seen it. A stock is going to the moon, your buddy at work is bragging about how much money he's made, and every social media app is screaming about it. That fear of missing out, that FOMO, is so powerful. It makes you want to just dive in head first. But that is where the trouble begins.
I love this old saying because it is just so true. Basically, by the time a stock is so popular that everyone is talking about it, the smart money, the people who got in early, have already made their profits and they are looking for the exit. And here's the tough part. When you buy that super hot stock right at its peak, you're not really an investor. You're what the pros call exit liquidity. It's a fancy term that means you are the person they're selling to so they can cash out their winnings. Ouch. It's a painful lesson.
Now this one can feel so logical at first. You love a product, you use it every day, so you think, I'll just put all my money in that company. But loving a company doesn't protect its stock. It's called concentration risk, and it's dangerous. One bad earnings report, one new competitor, and poof, your entire savings can get decimated overnight.
The rule here is super simple. Try to never put more than, say, 5 to 10% of your money into any single company. For most of us, the easiest way to do this is with low-cost index funds or ETFs. They automatically spread your investment across hundreds of companies. Remember, diversification isn't a get-rich-quick scheme. It's a don't-go-broke strategy. It's about survival.
Ah yes, the siren song of timing the market. It's so tempting, isn't it? The idea that you'll be the genius who sells at the absolute peak and buys back in at the rock bottom. The reality? Not even the pros with their supercomputers can do this consistently. So what chance do the rest of us have?
And this really gets to the heart of it. It's not about timing the market, it's about your time in the market. One is a guessing game. It's basically gambling. The other, just staying invested through the good and the bad, is what allows you to capture that long-term growth. It's the strategy that's proven to work. Let's talk about the 2 emotions that absolutely wreck portfolios: fear and greed. They're a deadly combination. Greed makes you buy high when everyone's ecstatic, and fear makes you panic sell low the second the market dips. You end up doing the exact opposite of what you should. You know, the most successful investors, they're actually kind of boring. They just have a plan and they stick to it.
And the final big mistake is a sneaky one. It's fees. They always seem so small, don't they? Oh, it's just a 1% fee, what's the big deal? Well, over decades, that tiny little percentage acts like a parasite, just slowly and quietly eating away at your future. So let's make this real. Imagine over your lifetime, your investments have $100,000 in gains. That's great, but you've been paying that tiny 1% fee the whole time. How much of that 100 grand do you think that fee actually took from you? Take a guess.
$30,000. Yeah, that is not a small number. That is a car, that's a down payment on a house. That is a huge chunk of your retirement. That's the power of compounding working against you. That 1% fee can wipe out nearly a third of your total returns. I love how the source material puts it. You're being robbed in slow motion. The lesson here is simple. You have got to know what you're paying in fees. Okay, now that you know the 5 big mistakes, let's go a level deeper and talk about 3 hidden killers that can sabotage your wealth-building journey. First up, the debt trap. And the math here is, well, it's just brutal.
Look, if you're paying 22% interest on a credit card, but you're hoping to make maybe 10% in the stock market, you're fighting a losing battle. You are mathematically guaranteed to lose money. The single best investment you can make is paying off high-interest debt, period.
Next up is something we've all felt: analysis paralysis. You spend weeks, maybe months, researching the perfect investment, trying to find the perfect strategy. And while you're doing that, the market is moving on without you. This quote just nails it. A good strategy that you actually start today is infinitely better than a perfect one you start, well, never.
And the third hidden killer is treating your investment account like a piggy bank. Every time you pull money out for a car repair or some other short-term thing, you're not just losing that cash, you're stealing all the future growth that money could have generated. Think of it this way: that account is for your future self. Don't steal from them.
Okay, I know that was a lot of don't do this and watch out for that, but now let's talk about something incredibly empowering. Because as a beginner, you have a superpower. You have the single most powerful force in all of finance on your side. And that secret weapon is time.
This timeline is just incredible. Look at this. Sarah starts at 25, investing just $200 a month. John waits 20 years, but to make up for it, he invests $800 a month. That's 4 times as much. So who wins? Sarah. She ends up with $100,000 more than John, even though she invested less actual money. Why? Because her money had more time to compound. This proves that when you start is so much more important than how much you start with.
All right, we have covered a ton of ground. Now, let's boil it all down into a simple, clear action plan that you can use to get started.
Here are your rules to remember. Ready? Don't chase hot stocks. Diversify your money. Remember that time in the market beats timing the market. Leave your emotions at the door. Watch those fees like a hawk. Kill high-interest debt before you do anything else. And most importantly, just start. Start now! Time is your best friend.
So here's the bottom line. Countless investors have already paid the expensive tuition for making these mistakes. They've learned these lessons the hard way. You get the benefit of all their experience. You get to learn the lessons without losing the money. The only question left is, are you ready to graduate and start your journey the smart way?